Morning, guys. It's Thursday, August 21st, 5:24 a.m. Central Time. Grain markets are mixed to higher this morning. December corn futures up 1.5 at 405.5. November soybeans down 1.5 at 1034.5. December Chicago wheat up 5.75 at 534. December Kansas City wheat up 4.5 cents at 527.75. December spring wheat up 4.25 at 593.25. We've got some more crop tour news to start off today.
So the Pro Farmer Crop Tour released its Illinois and Western Iowa corn and soybean crop findings yesterday. In Illinois, corn yields were estimated at 199.6 bushels per acre, the second highest in tour history, trailing only last year by 2.2%. The state's average soybean pod counts were up 4.2% from last year, setting a new tour record. Corn and soybean estimates in western Iowa were above average, indicating that record yields may be realized. Corn yields across all three western districts were an average of 10% above the three-year average. Soybean pod counts across the districts were an average of 18% higher than the three-year average. Despite this, concerns remain about the potential impact of crop diseases on final yields.
Let's talk slowly about this. So, to start with Illinois corn, crop tour estimated the state average corn yield would decline by 4.6 bushels per acre or 2.2% versus last year. That's tour versus tour. So the tour says the Illinois corn yield is going to decline. USDA, however, has estimated that the state's corn yield would rise by 4 bushels per acre or 1.8% to a record 221 bushels per acre. That's USDA versus USDA. The tour and Pro Farmer will tell you that they typically come in light for the state of Illinois to the tune of 3.9 bushels per acre. So if you were to make the adjustment, take that 199.6, add 3.9, that takes you to 203.5. That's still 17.5 bushels per acre below USDA's estimate. So I think the tour here, at least to me, is implying that the Illinois corn crop is average and there's some problems, and that it is absolutely not a record 221 bushels per acre. The scouts in Illinois said it looked great from the road, and when they got into the fields, it just wasn't that great. There were a lot of problems. It's just more of an average looking crop. Now to go into Iowa. So they did 3 districts yesterday, and they're the western part of the state. If you guys are watching on YouTube, that little map in the upper right-hand corner that tells you where they were. So District 1 is in the northwest corner. That's where they found some really good stuff. District 4 was in kind of the west central part of the state. And then District 7 is in the southwest part of the state. On average, across the 3 crop districts that Iowa toured, I think that the scouts toured, rather, I think Mackenzie said this, they estimated that corn yield would rise 6.6% versus last year, tour versus tour. USDA says they're going to be up 5.2%. So the tour actually telling you, hey, Iowa, at least the western third, is maybe a little bit better even than what USDA has told us. Now, USDA has got a record yield for Iowa penciled in, but I think that the tour to some degree kind of confirming that. When you go to soybeans, they found excellent potential in Illinois. Pod counts up 4.2% versus last year. USDA's got the state soybean yield up only 1.5%. So maybe implying that Illinois beans actually better than what USDA has implied. They said beans have a lot of potential, and the bean crop still has some ways to go, And then they did the same thing. They broke western Iowa out into 3 crop districts. And on average, over those 3 crop districts, the tour estimated that soybean pod counts would increase by a whopping 13.2%. USDA's got the state's average soybean yield only up 5%. So I think that with both Illinois and Iowa, the tour is implying that the soybean crop may be even better than what USDA has indicated to this point. So, you've seen, I think in corn, what you're seeing is maybe better stuff in the Western Corn Belt and maybe not so great in the East, and how they offset each other at the end of the day, I don't know, but that would be my take home. Pete Meyer is going to join us again today from the Eastern leg of the tour to talk about exactly what he found in the last couple of days.
Fanduel is teaming up with the CME to launch regulated betting contracts based on financial markets and economic data. Bets will be tied to benchmarks like the S&P 500 and the Nasdaq, as well as the price of oil, gas, gold, and cryptocurrencies. They will also be tied to major economic indicators such as GDP and CPI. Customers will be able to place yes or no bets for as little as $1. Unlike regular bets, these contracts will be treated like official financial products and will be subject to review by the CFTC. The contracts are expected to launch later this year and will be listed on CME exchanges and accessible through Fanduel's app.
Okay, I have a rant incoming. The CME, or Chicago Board of Trade, let's do some history. Chicago Board of Trade was founded in 1848 by a group of businessmen, farmers, grain buyers. They wanted a centralized place where they could offset risk. Farmers wanted to be able to sell grain into the future. Grain buyers wanted to be able to buy grain at different points in the future. They wanted a kind of central price discovery mechanism. And what they came up with was absolutely fantastic. It's worked for 170 years, right? When the CME, or the Chicago Board of Trade, and the Merck, when they merged and went public in the early 2000s, I think that the transition into away from being a risk management tool and into more of a casino kind of began, and it's accelerated over the last 20 years. So what they're doing here is something that's been tried before. I was working for Man Financial in 2008 when they launched something called the U.S. Futures Exchange, and they were doing exactly this. They were doing binary bets on all sorts of different things, from weather to where the S&P 500 was going to close. It failed within a year. But we're in a much different environment now where everybody is betting on everything on their phone. You've got apps like Polymarket and Kalshi and Predicted, where just Joe Public can go and bet on these binary outcomes. So essentially, CME is going to be clearing these binary bets, these yes or no bets on things like, where is the S&P 500 going to close at the end of August? Is it going to be above 6,500 or below 6,500? Yes or no, place your bets. That's where it's going to start. And then it's going to transition into more of a casino, and people will be betting on whether or not the guy at the Coldplay concert is going to get divorced, or what color dildo they're going to throw on the WNBA court tonight. I don't like this at all. The thing about CME, and the thing that's happened since they've become public, is this: you, the trader, the farmer, you're not the customer, you're the product. The customer is the shareholder. And CME's job here is to generate as much volume as humanly possible so that they can keep the stock price elevated. They don't have your best interest at heart here. They don't. And this is off on a tangent. This isn't corn futures or soybean futures, but I think it gives you a glimpse into what CME cares about and what they don't care about. And they don't care about being a upstanding futures exchange where risk is transferred. They care about generating as much volume as humanly possible.
Sovicon has raised its forecast for Russia's wheat crop. The consulting firm estimates this season's crop at 85.4 million metric tons, up slightly from the previous estimate of 85.2. The revision reflects favorable weather in Siberia and the Urals that is expected to improve yields. However, even with a better than expected crop, logistical challenges in moving wheat are likely to complicate exports in the coming months. Sovicon left its estimate for Russia's total grain production unchanged at 130.5 million metric tons.
I'll tell you what, we've seen these increased crop estimates, but I have one piece of good news for you today. Chicago Wheat Futures posted a reversal to the upside yesterday. This was not a key reversal, but it was a reversal. We found a little bit of follow-through buying overnight. I'm going to be cautiously optimistic and say that there's a 50% chance that was a bottom. And I'd love to see some follow-through buying. This wheat market has been down and out for so long. Some sort of just technical recovery is in order. And if you actually found some good news finally, that would be very, very helpful, I think.
If you guys have not checked out our premium content, you sure need to do so. Joe, can you tell our viewers about some of our recent premium videos?
We're going to show you some cattle charts in a second because we've got a cattle story, and I can't analyze a cattle chart, and I'll tell you why, and you can look at it. But Brian Split can, and he did an excellent job of that yesterday. He also ran through grains. What else did he do? Did grains, cattle?
He had cotton and rice.
Yeah. So if you guys are looking to get away from the noise and focus on the charts, which is what Brian does, and he's the best in the business at doing it. These videos that we do with Brian on charts every 2 weeks are absolutely fantastic. Pete gave us an update from the Eastern leg of the crop tour on Monday, and he's going to be back today. I want to ask him about Illinois in particular, and just get the kind of boots on the ground view. And Pete will tell it exactly how it is. He's not going to bullshit you in these videos. If you want to see the premium stuff, go to standardgrain.com. You can sign up this morning. This is a $50 per month subscription. You can cancel it any time. There's no other fee, no other obligation. Nobody will try to sell you anything else. Guys, I would love it if you would support what we're doing here. We do YouTube for free. We do the podcast for free. We lose money doing it. The only way that we're able to do what we do is because We have premium subscribers who pay for our premium content, and the reviews are fantastic. We very rarely have people cancel. We do let you cancel at any time. We don't want to call you. We don't want to talk to you. We just want to send you our content, because really we do 10 episodes a week. We do 5 episodes here for free, but we've got a whole nother set of episodes that's really more in-depth kind of decision-making type material that's sent out to the premium crowd. So sign up this morning, guys. I'll give that deal a shot. I'll forward you a copy of this morning's email, which includes the 6 most recent premium videos.
Cattle futures extended their rally for a 4th straight session. Excuse me. Cattle futures extended the rally for a 4th straight session on Wednesday. With the exception of the August live cattle contract, all CME cattle futures climbed to new highs. The rally has been fueled by persistently tight cattle supplies and strong consumer demand. USDA announced last week that it has no intentions of opening the southern border to Mexican feeder cattle imports due to the continued spread of New World screwworm down in Mexico. The decision reinforces expectations for even tighter fed cattle supplies during what was already anticipated to be the tightest phase of the current cattle cycle. While box beef prices slipped marginally yesterday, wholesale beef values remain near record highs outside of the COVID-19 period, underscoring the strength of consumer demand.
I don't know how you analyze these charts. As I said, I mean, it's straight up. Here's feeder cattle. Here's live cattle. Mackenzie, recently, Donnie King, who is the CEO of Tyson Foods, said that U.S. cattle producers have either already begun the process of restoring the national cattle herd or are close to doing so. Are you of that opinion, or is this the Packer talking his book?
No, I would say there would be some rebuilding going on, especially just considering the moisture that cattle country has gotten this summer. But it's going to take a long time for us to get back to where we were, or even get close to back to where we were. And as long as we keep that southern border closed to Mexican feeder cattle imports, that's going to have a huge impact on our fed cattle supply.
So if that situation changes, say a month from now, is that a catalyst that could break the market or at least cause a big correction?
I believe so. Yes, I think we could see revised. I mean, we would be down. Yes.
Yeah. Yeah. And even in bull markets, you have corrections. Go look at
Yeah.
that one in April. I mean, that was especially nasty. You had one in June. It happens. We haven't had a decent one in a while now. Maybe we're overdue.
Federal Reserve officials view inflation as a greater threat than labor market weakness. According to minutes from the Fed's July meeting, most policymakers see inflation risks, particularly from tariffs, as outweighing employment concerns. During the meeting, officials debated whether tariffs would trigger only a temporary rise in prices or a more lasting inflation shock. The Fed left interest rates unchanged at 4.3% last month, citing heightened uncertainty as economic activity slowed in the first half of the year. Recent economic data reinforced the Fed's cautious stance, with wholesale inflation climbing to a 3-year high. At the same time, unemployment has risen to 4.2%, while recent downward revisions to payroll gains showed hiring has slowed to its weakest pace since the pandemic.
It appears very likely that the Fed will cut rates on September 17th. Treasury markets would indicate that there's an 81.2% chance of a quarter point rate cut on September 17th. I think there are some people looking for a half, but that doesn't seem to be consensus at this point. The inflation situation is interesting. It's still, I think, higher than they'd like it to be. Your most recent CPI print was 2.7%. And, the Fed has said for years, like 2% is our target, but we've never sniffed 2%, not in this cycle. Our friend Jim Urio, who knows much more about this than I do, he believes that the Fed has essentially quietly raised its inflation target, and that really what used to be 2% is now 2.6, 2.7, maybe as high as 3%, and that they're still going to cut rates. So I don't know. This isn't going to be enough to really affect you guys a whole lot in terms of like operating notes or anything like that. I guess they're going in the right direction, but don't expect the 2% interest rates to come back anytime soon.
U.S. ethanol production declined last week. Weekly output of 1.07 million barrels per day was down 2% on the week and down 2.4% versus the same week last year. Ethanol stocks increased to 22.69 million barrels. The print was up marginally compared to the previous week, but down 3.8% compared to the same week last year. According to Reuters data, thanks to low corn prices, U.S. ethanol production margins remain strong.
Yeah, corn's cheap. So production's great. And maybe the more positive item out of yesterday's report is that stocks have fallen. There was a big drop last week and they kind of stabilized here. But the fact that we're falling into like what would be a normal range of ethanol stocks rather than like seasonal record highs is absolutely a positive thing for ethanol prices.
USDA reported 2 flash sales of corn yesterday. U.S. exporters sold 4 million bushels of corn to Colombia and 5 million bushels of corn to Mexico for delivery during the next marketing year.
Yeah, corn demand's excellent. We talk about it on almost a daily basis. These flash sales pop up. They're not huge flash sales. They're 100, they're 200,000, but they're accumulating. And the book of new crop export sales is the second best of the last 10 years. We're trailing, I think, only the 21-22 marketing year. So corn demand on the export front is great, although it must be said and reiterated that USDA has a very lofty new crop corn export number penciled into the balance sheets. And we need to see these sort of sales in order to hit that target. We talked about cattle. Stock market's off a little bit this morning. The Dow's down 160. The S&P's down 12. Treasuries are off just a little bit. U.S. dollar's about flat. Crude oil is up 60 cents in the October WTI at 63.32. Have a great day, guys. We'll be back Friday.